U.S. natural gas futures declined about 1% on Friday to hit a two-week low, driven by a smaller-than-expected drop in production, reduced flows to LNG export plants, and forecasts of weaker demand. June futures settled at $3.33 per million British thermal units, marking their lowest close since April 30. Over the past week, prices fell roughly 11% after nearly a 29% surge in the prior 2 weeks. Despite recent heat in Texas, analysts expect overall heating and cooling demand across the U.S. to remain modest, allowing utilities to continue injecting above-average gas volumes into storage, which is currently about 3% above the 5-year average for this time of year. Average production in the lower 48 states decreased to 103.7 billion cubic feet per day in May from a record 105.8 billion cubic feet per day in April. A temporary drop to around 103.1 billion cubic feet per day on Friday reflects spring maintenance on pipelines such as Kinder Morgan's Permian Highway, which is undergoing turbine replacement that lowers its capacity to about 2.2 billion cubic feet per day. This maintenance has led to some gas accumulation in the Permian Basin, causing spot prices at the Waha hub to fall to about 94 cents from $1.58 the day before. Gas demand, including exports, is expected to hold steady at around 96.3 billion cubic feet per day this week and next, before easing slightly to about 94 billion cubic feet per day in 2 weeks. LNG feed gas volumes to 8 major U.S. export plants have dropped to 15.1 billion cubic feet per day so far in May from a record 16 billion cubic feet per day in April, due mainly to maintenance at Cameron LNG in Louisiana, Cheniere's Corpus Christi facility in Texas, and temporary cutbacks at Freeport LNG. Flows to Corpus Christi are near a 2-month low of 1.5 billion cubic feet per day, while feed gas to Freeport is rebounding to a 4-month high of 2.2 billion cubic feet per day. In summary, the recent dip in U.S. natural gas futures is a result of a confluence of factors, including steady production, reduced export flows, and forecasts of lower demand. These elements combined have led to an oversupplied market and consequently, lower prices. Natural gas prices are under bearish pressure, approaching key technical support levels. The market has broken below the 50% Fibonacci retracement at $3.35 and the previous day's low of $3.36, signaling a continuation of the downtrend. The next significant support is near the 65% Fibonacci level at $3.20, which could act as a critical zone for potential reversal or further decline. A daily close below this support would reinforce the bearish outlook. Conversely, a rebound above $3.35 may indicate a shift towards a neutral or bullish trend. Please like, subscribe, and comment to support the channel. See you in the next one.